Welcome to lesson 5. This is where we're going to be learning the InevitTrade crypto system. So the back-tested system that I have designed over the past 2 years, I'm going to be explaining to you in detail so that you can basically create your own watch list, search for your own plays, set them up, and be able to take trades in a very systematic, regimented way that is statistically proven to make you money over time. So I'm going to be teaching you that exact system so that you can start generating your own profits and be a crypto trader with a solid system. So basically, this is the back-tested InevitTrade system. This is taking all of the stuff that we have learned so far in the course and implementing it into a practical trading strategy that is proving to work over time if executed properly. So I'm going to walk you through the verbal walkthrough of how the system works, and then we're going to get right onto a chart and show a long example and then also a short example on Ethereum and Bitcoin. Okay, so basically the way this trading system works is as follows. Step 1, we're going to scroll all the way out on a 15-minute chart on TradingView. And like I said, I'm going to show you exactly step by step how to do this on TradingView and how to find the trades and set them up and handle the trades systematically on a chart. But just bear with me and try to comprehend it while I'm reading it. Number 2, establish an area where there has been a significant range break, new trend push, followed by a corrective wave, followed by another impulse wave. So a corrective wave is a pull down or a sharp pull down on a trend, and an impulse wave is a longer term move inside of a channel. So we have over here, we have a larger move right here, which is going to be an impulse wave, and then a corrective wave is the shorter, more sharp, rash corrective waves, essentially. Number 3, add different trends that seem to be lining up with various price action in trends of the direction of the new impulse wave. So this takes time to perfect. Interior are going to be thin dotted lines and exterior are going to be solid lines. So like we talked about with the supply and demand imbalances, we want to look at levels where we're seeing the price bounce off of. We want to use dotted lines on interior ones and solid lines on exterior trends that we find in order to be able to optimize our risk reward when we're doing our position sizing. So just bear with me and you'll understand why in a second. But we want to draw a bunch of different trend opportunities within this channel to see where there are possible tops and bottoms so that we can then take reversal trades off of these. Step 4, enter a position calculator for an entry on the central trend where the impulse wave will touch the first trend line. So basically what we want to do is, number 1, we want to find a new range break. So that's what we have right here. Number 2, we want to basically find a corrective impulse wave, which is what we found right here. So we have a high here, a low here, and then another high here. And this is if we want to long a cryptocurrency. Okay, so this is the long strategy. If we want to long something, we need to establish a high, a low, and then another high to predict that secondary low, right? And that's going to allow us to create a channel, which is going to allow us to create a projection. So once we have this channel established with our highs and lows, and we found a breakout range and an impulse wave with 2 highs and a low, we want to project our new low down to the low of this channel. Now, I know there's a lot of steps here, but just bear with me. This is the price projection to move on the trend in the corrective wave. So we can watch this come down here, and we know that this is going to touch at some point off of the low of this trend, and that's where the likelihood of us getting a reversal and a continuation up higher is the most probable. So that's where we're going to want to look to take a long position. So our next step in step number 5 is to add a position size calculator. So I'm just going to take this off right here, and we're going to add one. Okay, so now that we have the price coming down, let's say the price is somewhere in around here, we want to grab that position calculator for a long position and click right on the interior portion of the trend. And I'll explain to you why we're doing that on the interior in just a second. So you place a figurative one right there, even though the price hasn't reached it. And what you want to do next, basically just leave that alone for right now, because next we're going to basically position the risk reward to 61.8 on the profit target and then move our stop loss so that we have at least a 1-to-3 risk reward ratio outside of the exterior trend. So basically, since the price could hit off the interior trend right here, which is represented by the dotted one, and we also have the exterior trend represented by the solid line, that's kind of like the outer parameters of where we should realistically see the price of the cryptocurrency. Same thing with the dotted line on the bottom. What we want to do is we want to make sure that our stop loss is outside of the exterior trend because if we're wrong about the interior entry, we don't want to wait because we don't want to miss it if it doesn't hit the exterior but hits the interior, but we want to place our stop loss outside of the exterior trend. So even if we were wrong about taking the trade off of the interior trend, we still have the chance of it breaking through the interior trend, going to the exterior trend, and then turning around. So we want to kind of cater to both by entering on the interior trends, but accounting for the exterior trends. So if we enter on the interior trends, we won't miss out on a trade. But if we account for the exterior trends when we're planning for our risk reward and placing our stop loss, we'll be able to place our stop loss outside of the exterior trend so that we don't get stopped out unnecessarily if there isn't a trend break. Okay, so what we want to do is we want to move our stop loss outside of the exterior solid line trend. Just keep it in a pretty realistic, normal range away so that if it did break through that line, it's most likely going to continue in the opposite direction. Now that we have our Fibonacci placed off of this low right here coming up to this high, we want to look at where the Fibonacci is projecting the lines to go. So basically, I don't know, I can't remember if I showed how to do this, but we want to grab our Fibonacci tool and we want to basically click from high down to low. So once we have our Fibonacci off of the low of the price action or where we expect the price action to be, we can then move our profit target to the 61.8 level, which is where our profit target is going to be in the system. So once we have our profit target positioned to the 61.8 level, we can start evaluating our risk reward and where we should be positioning our stop loss. If our stop loss is outside of the exterior trend in a realistic space and we're not getting the 1-to-3 risk reward ratio that we're looking for, that means you don't want to take that trade, right? So in this circumstance, since we have it in a reasonable area outside of this trend for it to come down and still have space to breathe without stopping us out, we're still looking at a 3.37 to 1 risk reward ratio. So we're making 3.37 times the amount if we're right about this trade than when we're wrong. Basically, once you have that set up and you look at all the Fibonacci levels reacting nicely, have our profit target projected at the 61.8 level, have our stop loss at least 1-to-3 risk reward ratio, that's where we can start planning our entry and putting our limit orders and putting our range orders for the stop loss and profit target. So take a position if step 6 conditions are met. Enter slightly inside where the trend is so you don't miss, and place your stop loss to at least 1-to-3 risk reward ratio. So just like we talked about, we want to take the trade on the interior but account for the exterior. So this is where the next part happens, and this is where the next rule comes into play. So as soon as the price action, and I'm going to draw on the screen here so we can kind of imagine what happens. As soon as the price action bounces off this level and comes up to the 23.6 level that we're looking at on the Fibonacci right here, this is where we want to start reducing our risk, usually by about half. Okay, so we're not going to reduce it quite to under lows right here, but we're going to basically shave some off because we know that now we're basically confirmed that we're right about it bouncing off of this interior trend and turning. So if it does continue going down and it ends up being wrong, we don't want to stay in that trend. We've been able to time it well enough so that if we are right, we want to basically position ourselves so that if we're wrong, we're losing less. So we want to decrease our risk once we hit a bounce and then off of the 23.6 level. Okay, so then the next step is going to be once the 23.6 level is hit, risk reduced to over highs. That way, if we are wrong, which we often will be, we can cut our losses significantly. So we can basically decrease our stop to about this level. We don't want to quite go to under lows unless it's absolutely tearing face. I like to keep it a little bit of leeway still so that we're not cramping the trade, but we're definitely reducing our risk. Now we have a 6 times position, so we have a 1-to-6 risk reward ratio now, which is now incrementally shaving down the amount of risk we're taking on this trade. Once the 38.2 level is hit, if there's a corrective wave in the trend direction, stop goes in the money slightly outside the corrective wave once it touches the 50 level. So assuming that the price continues to move up and we hit this level right here, and then we have another corrective wave down here, and then another impulse wave up higher, as soon as we hit this 50 level right here, we want to then move our stop loss in the money just under this corrective area right here. So see how we have a touch up to the 38.2 level and a pull down, and then we have another impulse wave up to the 50 level. This little peak right here is where we want to put our new stop loss. So now it's either we make a little bit of money or we make our full profit target. There's no more risk on the table. We are going to make money on this trade regardless. Obviously, like I said, you're taking profits at the 61.8 level. So as soon as the price hits this 61.8 level right here, you can see it hit. That's where we would make a full profit trade. So on this trade, we were initially risking 3.37 to 1 on the risk reward ratio. So if we risked $100 to make $338, that's what we would make on the trade. Eventually, we reduced the risk down so that we were risking about half. So we were risking about 50 to make the same amount. And then as soon as we had that correction and then move up, we're now risking probably making $50 or making $338. So that's kind of how we incrementally walk into the trade. So you want to make sure you find this range break in a corrective wave down, 2 highs and a low, and then you want to project where we're going to have the next corrective wave down, draw interior and exterior trends, draw the Fibonacci on where it should be interacting with the low of the trend to get your levels correctly, put a profit calculator on there so that we get at least 1 to 3 risk reward with the stop loss comfortably outside of the exterior trend with a profit target at the 61.8 level, and then you manage the trade as soon as we have the 23.6 level hit after the rebound right here. We want to reduce our risk by basically half to slightly under lows, but you want to keep it realistic. Then if we have a touch of the 38.2 level, a correction, and then a continuation up to the 50 level, we put our stop loss in the money under that second corrective low and wait for either a stop out in the money or a full profit at the 61.8 level. So I'm basically going to completely redo the trade in front of you now from scratch so that we can kind of visualize how to do it. Okay, so first I want to see a range break, which we can clearly see right here. So boom, we have a range break up, okay? Then we establish this new high right here. We then have a corrective wave down. This is where we've established our first low. Then we have a continuation of the trend right up here. This is where we've established our secondary high on the range. Okay, so now assuming that we pretend like this area is not here yet and we haven't seen this, this is where we're going to start drawing our trend lines. Okay, so we want to draw our trend lines from this high to this high over here. Then we're going to grab this and we're going to clone it. So we're going to clone that line and move that line down to the low right here. We want to draw our secondary lines right here. This time, these are going to be dotted. So we're going to go in here and we're going to switch to dotted. We have a high established right here as well. So we can definitely see that there's a deviation in the trend being established. We're going to drag right here, right here. We have these lows hitting points right here. So these are all secondary levels that we want to consider. So we're going to clone this level right here. We're going to place this on the low here. Then what we're going to do is we are going to grab our Fibonacci retracement and go from the secondary high down to the projected low on the interior of the trend. So we want to put our 0 right where we should start to see the price action failing off and going to the interior dotted line. Remember, we're taking action on the dotted lines on the interior of the trend and accounting for the exterior solid lines on the trend. Okay, so we have this projected. The levels look good. We see the price reacting off of this level right here. Next step we want to do is grab our long position and we want to figure out where the price is likely to hit on the interior. We then take our profit target and we put that at the 61.8 level. Now we want to move our stop loss comfortably outside the exterior trend to give us at least 1 to 3 risk reward. So we push it right about there. Now, if you look, this is a comfortable area where the cryptocurrency has a comfortable range to breathe in without getting stopped out, but we're still optimizing. So we still have 3.3 times the amount of profit that we do have to the risk. Then all we do is set either a limit order or we wait for a market order. Once the price touches this interior trend right here, this is where we're going to take action and buy. You'd open your position here, your stop loss would be placed right here, and your profit target would be placed right here. As soon as the price rebounds off of this level, and assuming it doesn't stop us out immediately, it comes up. As soon as we hit the 0.238 level, we want to reduce our risk by about half. So we're going to reduce our risk to about there. Now we have about 5.56 risk reward. As soon as the 38.2 level have a turn down and then a continuation up to the 50 level, we want to take our stop loss, completely reduce it to 0, and put our stop loss underneath that secondary low from the pullback. So that would mean that our secondary low would be put right around here after this little pullback. Then it's either we get stopped out in the money for a small gain, or we make a full profit target at the 61.8 level. And as soon as all of that is done, you're going to log your trades and store your trade information. You want to take a screenshot of the trade and you want to log it so that we can evaluate the performance of the trade and figure out if you're taking the right trades and how you can improve the trades that you are taking.